Good morning or good afternoon, depending on where you might be in the world. My name is Mark Nielsen. I am coming to you from San Diego, California, and we want to welcome you to another series in the Expert Insight series with Renaissance Executive Forums. Personally, I am a recovering CFO. After 25 years of CFOing, I sit on a number of public and private company boards, and I've been a partner with Renaissance Executive Forums for the last year, and particularly focused on setting up forums for financial executives. And we have a number of those going and a number in the works. I've got a great topic today and a real subject matter expert on this, and I think you'll find it intriguing. I'm honored. I'm going to introduce to you Ben Falk. Ben is currently in London with Ernst & Young, with EY's global think tank called EYQ. And Ben has certainly circled the wagons on this cool topic of the future of money is unbundled, because he has sat in different seats around the table, having spent 10 years working for a very large hedge fund as their macro strategist. But he also was in the fintech industry and the artificial intelligence side of that with a startup. And he's been in the VC-backed world. But today's topic is really intriguing because I think he'll talk a little bit about the history of things. But, you know, it used to be simple. It was just you put your money in a bank and banks would, you know, keep it, move it to you or wherever you wanted. But now it's been broken up into so many pieces, and it's gotten so complex that so much specialization with technology and finance. So looking really forward to hearing what Ben has to say. A little bit of housekeeping, if you will. Ben's going to talk for about 40 minutes. And we've decided that we're going to hold the questions, but you'll notice on the side of your screen, there's a comment section. So just feel free to put your questions in there as Ben goes along. And the last 15 or 20 minutes we'll save for going through those questions. So we'll do that all at the end. This is being recorded, so you'll have access to it, or if you want to share it with anybody later. So keep that in mind. And I think I have covered it. And so, Ben, really pleased that you would join us for this today. And I'm going to turn it over to you. Thanks so much.
Well, thank you, Mark. And hello, everyone. Really delighted to be here. So today, I'd like to provide a framework for thinking about the disruptions that are happening in financial and money markets. And so money performs, we'll start with the basics, which is that money performs three social functions simultaneously. The first is storing value, which satisfies future consumption, and we typically call an asset or a liability equivalently, or a security. The second function is exchanging value, which satisfies current consumption demands, and what we typically call cash or currency. And the third function is measuring value. We use money as an accounting unit, and we typically call that credits and debits. And so you might have heard a story, an economics fable, about where money came from. Which is that money arose as a result of a barter economy. In pre-modern days, it was before money. It was difficult to know how many chickens were equivalent to one cow, right? And so we developed money in order to enable unit pricing. But there's a real problem with this story, which is that there's no real evidence in support of it. If you ask archaeologists and anthropologists, what they tell you is that no society that they've seen ever used barter as the primary mechanism for exchange in their society. Barter did occur sporadically throughout history in many places, but it was never the main distribution mechanism that people relied on. And so instead, what the consensus among this group of scientists is that the first money was likely a credit and a debit, simply a ledger, an accounting unit somewhere. And so up here is what's called the Ishango bone, which is discovered in 1950 in the Belgian Congo. It's a baboon fibula. And what makes it so special is that it has 3 columns of tally marks running the length of the tool. It's about 20,000 years old. And so this makes it one of the earliest, not the earliest. We have earlier examples of what's called a tally stick, which is now established in later years to have been used as a currency. And so if tally sticks are currency, well, this pushes the history of money much further back than we had previously assumed. Sorry, my screen's frozen there. And so what these historical origins tell you is that money is really an information good. It's just an accounting tool. Elon Musk says correctly that money is data, nothing more than bits of information or strings of ones and zeros. And more formally, former Fed Governor Narayana Kocher-Lakota published a seminal paper titled "Money is Memory." And what he shows in this paper is that mathematically, an information storage and communication system is a functionally equivalent substitute to a cash-based system. So money is just an information good. And it follows, therefore, that information technology is really a primary driver in how we all use money. And indeed, some historians believe that writing itself one of our earliest information technologies. For example, like this cuneiform stone tablet here. Writing was invented in order to keep better accounts. And I really hope these historians are right. Working at an accounting firm, it would make me feel good that we know accounting can drive innovation. But stone tablets aren't great mechanisms, and particularly for long distance exchange. And so pre-modern societies innovated by developing tokenized money, which could be carried across distances. And they first used things like mollusk shells before metal ingots, and then coinage was developed. But when precious metals went into short supply, new information technologies stepped in to fill the gap, namely paper and printing. And so interestingly, paper currency was first issued by private merchants in Tang Dynasty China. The state took over paper money issuance a few centuries later, and state-backed paper money slowly spread around the world and remains a dominant payment means in many countries still today. But the first digital financial transaction was actually conducted over the US Department of Defense's ARPANET, the precursor to the internet, in 1972. So shortly after this information technology came around, we realized that it could be used for financial purposes. And it was between two students at MIT and Stanford. And since then, what we've had is repeated waves of digitalization have been sweeping through the financial system in the decades since. And now those digital tokens are now increasingly displacing paper. And so what's the point of this history? Why run through this? Well, what it shows us is that cryptocurrencies are decidedly evolutionary rather than revolutionary. None of ledger money, tokenized money, private money, or digital money is new, and 3 of the 4 of them are literally ancient. And so today, the information technologies that are disrupting money markets are advances in cryptography, networks, and software. And so in some sense, the tech has brought us back full circle, really to the origins of money as simply a record-keeping tool. Now, what is new about cryptocurrencies, what is innovative, is that the money is now decentralized and autonomous. And so the ledger is now distributed across a network rather than stored and managed centrally, and that it operates algorithmically, independent of any direct human input. And we'll talk a little bit later about why those features are proving attractive to participants who are adopting these instruments. So the other point that this history highlights is that governments, sometimes slowly and begrudgingly, but eventually do adopt emerging information technologies to improve their money systems. And today we are rapidly accelerating towards CBDCs, or central bank digital currencies. Now, these are conceived as a government-issued, universally accessible, peer-to-peer electronic alternative to physical paper cash. What the concerned policymakers are addressing is that if cash falls further out of favor and demand for cash has weakened due to hygiene fears during the pandemic even further, although it's been on a decline for some time, if there's no demand for cash falls further, then the public won't have access to a direct liability of the central bank. And so what they want to do is offer a digital token that competes with all these new private sector instruments that are coming out. And there are 2 basic models, and we'll talk about those a little bit later on as well. The first is a wholesale model, which targets a medium of exchange or a payments functionality. And the other is a retail model, which targets a store of value functionality, the 2 highlighted in gray in the middle of that chart from the Bank for International Settlements there. And so now, because existing financial arrangements have remained pretty stable for a long time, and so no one can really remember when money didn't perform all 3 of these functions simultaneously. But actually, we have a number of examples throughout history where money was unbundled. And so it's been bundled together for a very long time. But now what we're seeing is instruments being designed specifically for a single use case of money rather than all 3 at the same time. And this is really a classic startup disruption strategy. You target an incumbent in the sector by going after one part of their existing product bundle. You don't go after the whole portfolio because you can't compete with them at that scale. So you pick apart their offering and offer an improved product or service that goes after that specific market. And so bundling is common in a number of different sectors, but it's particularly common. It's a particularly common strategy in information and technology markets, which are often sold as a package rather than as standalone products. For example, Encyclopedia Britannica or Microsoft Office, excuse me. And indeed, because money is an information good, these strategies are also readily applicable. And so what we're seeing is money being split apart. Instead of those three roles, we have instruments designed for just one role. And so to explain this and illustrate this unbundling of money, I'll walk you through three recent case studies. So first, I'll step through the history of the Bitcoin network and their hard fork from a few years ago. And I'll show how this solution is really an innovation in terms of how central bankers manage the trade-off between these multiple functions. And so this is a problem that every money issuer faces, including modern central bankers and every cryptocurrency token out there. And so we'll begin to understand about money as an asset, but not as a currency, and what that means and what that could look like. The second one is the opposite, money as a currency, but not as an asset. And we'll explore China's recent experiments with digital programmable money, their digital currency electronic payments mechanism. And we'll see that this is a milestone, an international milestone in terms of central banking, because what it does is it enables some new instruments to be designed that could help central banks reach their policy objectives. And the last we'll look at the Ethereum network and how its ecosystem of decentralized finance, or DeFi, has discovered what makes money a useful accounting unit and why. And so this is an example of money as a unit of account, but not as a currency. And finally, I'll conclude with some points to bring it home to your day-to-day. And so the first case study here is on Bitcoin, which is you can think of money as an asset, Bitcoin acting as an asset, but not as a currency. And so the term cryptocurrency is really a misnomer applied to Bitcoin, whose architecture and governance make it much better suited to storing value rather than exchanging value. And that's because it has a fixed number of tokens released on a preset schedule. And so Bitcoin is designed, it's engineered to be artificially scarce. But when you have a fixed quantity of something, the only adjustment mechanism to shifts in demand is the price. And that leads to exceptionally high price volatility, which is an undesirable feature in a currency, in a medium of exchange. You don't want a bag of carrots to cost 1 Bitcoin on Friday and 5 on Monday. And so as a result of this feature, this artificial scarcity that generates this excessive volatility, the adoption of Bitcoin as a currency, as a medium of exchange, has been practically non-existent, very, very slow indeed. About 2% of transactions in the Bitcoin network are medium of exchange, current consumption. Now, with that said, at the same time, a fixed supply is an attractive feature in an asset. Think about beach houses in Malibu, or the old Mark Twain quip, buy land because they've stopped making it. When you have a fixed supply, if demand grows, the price must adjust higher. And so to be sure, most interest in Bitcoin is speculative. And demand is rising from retail investors, institutional investors, and hedge funds. And so the point of this story is that Bitcoin in its early days, when it was first introduced, suffered from what a venture capitalist would call poor product market fit, meaning its design satisfied future consumption demands better than current consumption demands, despite being marketed as a currency. And so this poor fit led to conflicts within the Bitcoin network. Some members of the community wanted to make governance changes to meet that threshold of that initial market target to make it useful as a currency. They wanted to raise the block size limit or mint additional tokens, which would make it better suited for exchange purposes. But most of the network resisted, and when no agreement was reached, a breakaway subnetwork implemented what's called a hard fork. And what all that means is they duplicated the underlying blockchain software, including the transaction history up until that point, what was stored on the ledger, and they pushed ahead with a new governance framework to create Bitcoin Cash. So central bankers would recognize this conflict. Up there on the left is British banker and economist Walter Bagehot, who identified the very same trade-off facing a money issuer in 1873 after he lived through the banking panic of 1866. What he noted back then was that because money was sometimes used for multiple purposes, it maybe could not do both very well at the same time. And so, for example, during financial crisis, when demand for money is very high, whilst firms and households hoard cash, money in fixed supply doesn't circulate very much. That makes it a pretty good store of value, but a really bad medium of exchange. And likewise, during economic expansions, when money is in ample supply and it's circulating widely and rapidly, it's a good medium of exchange, but a pretty lousy store of value. And so former Fed Chair Ben Bernanke actually cited Bagehot's dictum, which is the heuristic that Walter Bagehot developed about 140 years prior for optimizing this trade-off. How much liquidity should a money issuer inject in the face of rising demand and hoarding incentives? Well, there's no real good solution. It's a trade-off. And so how do you optimize that trade-off? Well, central bankers rely on this heuristic. But the Bitcoin network, facing the same trade-off, devised this alternative technical solution by simply unbundling the two functions. Instead of trading off along the frontier, they simply created a second token that was specifically designed to satisfy this one constituency. So instead of trading off, you push the policy possibilities frontier out. And so up there on the right is the standard way to model a trade-off, usually depicted with guns and butter, your production possibilities frontier. And we can think of financial technology as doing the same thing here. The policy possibilities frontier is shifting out. And so what that means is the trade-offs that have faced central bankers for centuries are being alleviated by some of this technology, and they can now create some new, better targeted instruments that will allow them to regain greater control over growth, employment, and inflation. And so we'll talk about a couple of those policy possibilities next. And so in this case study, we'll think about money as a currency, but not an asset. So the last one, we talked about how Bitcoin is really better designed to be a store of value rather than a medium of exchange. And in this case study, we'll look at the opposite. Money that's really designed to be a medium of exchange, but not a store of value. And to do that, we'll visit China, who's the most advanced country in the world in terms of executing a digital currency. And so the People's Bank of China, the PBOC, is committed to deploying e-money nationwide and recently conducted a series of experiments in major cities to test out its DCEP infrastructure. And so in Shenzhen, residents could apply for a lottery and winners received a digital cash disbursement via a government app. And so this cash, e-money that you won in this lottery, it could not be transferred to your normal bank account, and so it couldn't be saved, and it couldn't be gifted to anyone else. And so it was personalized, targeted directly to you, and it could only actually be spent at a selected number of retailers over a period of 90 days. If you didn't spend it in those 90 days, the money expired. And the reason that they did this is because they wanted to make sure that people actually spent the money so that they tested the infrastructure during the experiment. And so in effect, these balances carry a negative interest rate, right? If you don't spend it, it decays over time. And so spend they did. 95% of the e-money that was allocated was used to purchase goods and services during the test. And so this too is another old idea that's being brought to life again with new technology. And in this case, programmable money, meaning the money had an embedded program and an expiration date, which means it carried a negative interest rate. And so money that decays and expires isn't a very useful store of value. And that means it's almost certain to be spent rather than saved. And in that case, it's a very attractive tool for central banks who are seeking new ways to stimulate economic activity, right? Money that they inject that is sure to be spent is likely to have a higher multiplier, and that means the impact of their liquidity injections can be much greater. And so the idea for such an instrument was actually first proposed by this eccentric fellow up there named Silvio Gesell in the wake of the Great Depression. John Maynard Keynes called him an unduly neglected monetary prophet. And indeed, many of his ideas have been explored by central bankers globally in the last few years. And the reason they're so interested in this idea is because there's a case study that goes with it. A small town in Austria called Wörgl decided in 1932 to posthumously implement Gesell's ideas. And what they did is issued a community currency to be used just in their jurisdiction, and that currency lost its value every month. It depreciated by about 1% every single month. And the result was no one hoarded it, no one saved it, they spent it. And it resulted in a rebound in economic activity. Employment increased, growth increased, investment increased, and this was while the rest of the country remained mired in the Great Depression. And so if you think about where central banks are, more than a decade into quantitative easing and interest rates at or indeed below zero in many cases, this suggests that central bankers still have ammunition in order to stimulate the economy. And so China's digital currency electronic payments mechanism shows that these varieties of decaying money are technically feasible, and that's an important international milestone. Central bankers are not out of ammunition yet, and they're going to continue to get more aggressive in the face of additional macroeconomic risks as they materialize. And so expiring money is one simple example of the new instruments that are made possible with programmable money. But more complex programs are possible with smart contracts, and a host of new applications are proliferating within the open source Ethereum ecosystem where smart contracts were first developed. But by far the most popular instruments in this ecosystem are stable coins, which are a distinct variety of crypto instrument that are pegged one-to-one with fiat state-issued money. The peg is then managed by the private issuing entity, either algorithmically or in the traditional way by holding liquid assets in reserve. And so these stable coins, the utilization rose very quickly once they were offered. They've stimulated a range of decentralized finance or DeFi applications, and they are now the dominant anchor for a wide variety of this activity. And so what explains the rapid adoption of stablecoins? Well, we can quickly rule a couple things out. The first is that stablecoins' entire objective is to have a fixed price, to stay stable. But that's, of course, not a great feature in an asset whose price ideally you want to be able to rise over time. No price rises, no capital gains. And so stablecoins aren't really a great asset. They're not a great store of value. At the same time, stablecoins are not widely accepted as a means of payment. Few retailers, as far as I know, accept stablecoins in exchange for goods and services. And so they're not very good currencies either. They're not very good mediums of exchange. And what that leaves is the unit of account functionality as the backbone of stablecoin demand. And without question, stability is an attractive feature for the purposes of accounting. And indeed, this is basically why we all coordinate around the same unit of account. Economists theorize that balance sheet risks, interlocking balance sheet risks in the presence of credit chains is why we all adopt the same unit of account. These credit chains arise naturally with advanced forms of economic production because one agent's liability is another agent's asset and vice versa. It's cheaper and easier for everyone to denominate in the same unit. And of course, since the government both issues risk-free debt, their liability is our core asset, the private sector's core asset, and we have a liability to them, our tax liability, which is the government's asset. Our balance sheets interlock with them, and so we all denominate in the government's unit of account. But actually, this setup where the accounting unit is the same as the medium of exchange wasn't always the norm. And in fact, in medieval Europe, the unit of account frequently diverged from the medium of exchange. For example, up here is the French livre tournois, which is a unit of account, but not a currency. So all this flourishing activity in decentralized finance is the result of credit chains because they found their unit of account, a stable coin that they can use for some advanced financing activity. But if this activity, including the borrowing and lending of cryptocurrencies for yield farming, if it's driven by interlocking balance sheets and lengthening credit chains, then that means you have systemic risks arising in this ecosystem because materializing risks can spill over from one balance sheet to the next. And so stablecoins, by acting as the unit of account for decentralized finance, are systemically important to the DeFi ecosystem. And unfortunately, there's a couple worrying signs here. The biggest stablecoin, Tether, which is valued at more than 60 billion, and is the third or fourth largest cryptocurrency after Bitcoin and Ether in terms of market cap, they were recently found to have issued unbacked tokens by the New York Attorney General. And additionally, recent academic research published in the prestigious Journal of Finance links this unbacked issuance of digital tokens to significant price changes in the major cryptocurrencies, including Bitcoin and Ether. And indeed, around 2/3 of recent trading volumes in these instruments originate on Tether. So if these instruments are risky, it raises a really important question. Why are people taking so much risk with unproven and unregulated, highly volatile instruments that are frequently issued by poorly governed entities? Why? What's going on here? It's really not hard to understand that this is a risky endeavor. And to be sure, these tokens are often a negative sum game. Every unit of profit paid out must be financed by someone else paying in, net of mining costs. And so the chances that everyone gets rich are essentially zero. The user is exposed to significant counterparty risk. So what gives here? Why are cryptocurrencies emerging now? Well, I think the lesson from history is that private currencies generally emerge during periods of institutional crisis. And so we can see cryptocurrencies as a symptom of institutional decay. And so, for example, what you have up here is a variety of private money that was issued in the 1930s called scrip. It was issued by local banks during federally mandated bank closures. These banks could not access federal liquidity, but they still had customers banging on their door for their cash. And so what they did is created an analog variety of a stablecoin. It's pegged 1-to-1 with state-backed fiat money, and this is from the DeSoto National Bank of Arcadia in Florida. About $1 billion worth of scrip was issued by everyone from school boards and newspapers to wealthy individuals as the supply of cash was tightened. And so during this period of institutional decay, what you see is private issuers filling in, stepping into the gap and providing liquidity. And so if we apply some of these historical lessons to the current situation, to better understand why cryptocurrencies are emerging now, we can turn to this gentleman, who's the head of research at the Bank for International Settlements. His name is Hyun Song Shin. He's one of the smartest people on the planet, in my opinion, and he's been studying decentralized consensus mechanisms. So the mechanisms that provide the automation technology for the Bitcoin and Ethereum ledgers, the mechanisms used by these cryptocurrencies. He's been studying these for 30 years, since well before blockchains were even invented, using tools from game theory and economics. And he recently published a paper modeling the welfare benefits of a decentralized financial system relative to a centralized one. And so in what circumstances is it preferable? Is it better for everyone? Or are all our lives improved by adopting a decentralized financial system relative to a centralized one? And what he found is that only when the rule of law and contract enforcement is weak does a decentralized architecture generate higher overall welfare. So this may help explain why cryptocurrencies are so popular in countries like Venezuela, despite their obvious limitations. But it doesn't completely explain why they're being adopted in some developed markets. But it's worth noting that we are coming off the back of a string of high-profile and demonstrable financial crime. We have Bernie Madoff, to the LIBOR scandal, which MIT professor Andrew Lo calls the greatest financial scam in history, an estimated $1 trillion skimmed off the top. We have ISDAFIX, commodity market manipulation, mortgage securities fraud, the Panama Papers. The list goes on and on and on. And in today's world of social media, that information spreads far more easily than in the past. And of course, everyone knows that few people went to jail for these thefts. And so to be sure, we've known there's a problem here, that trust in traditional financial arrangements has been declining for some time. On the left there is the famous book, Where Are the Customers' Yachts? A Good Hard Look at Wall Street, which was first published in 1940 and was republished in 2005 due to overwhelming demand. In the middle there, you have former bank regulator Bill Black, who republished his classic book, The Best Way to Rob a Bank is to Own One, in 2014, after the 2008 financial crisis. And on the right, you have Looting, the Economic Underworld of Bankruptcy for Profit, by two Nobel Prize winners, originally published in 1993, and citations for which increase after every major financial downturn. And so the public has obviously taken note. If you a common theme, if you go and read the white papers for all these crypto tokens, what are they doing? What is their purpose for launching? What goals are they trying to achieve? Well, they often tell you, and what they say, including in the original Bitcoin white paper, is that the purpose of decentralizing the financial architecture is to reduce the need of relying on a trusted third party to review transactions. What they're saying to the traditional financial sector is that we don't trust you. We don't think you have our interests in heart. And so you can think about fintech. The reason that the technology sector is going after the financial sector is A, because it's very lucrative, but B, because they recognize there's a market opportunity given the loss of trust in the incumbent institutions. And so to conclude here, I'll just mention four quick implications. And so if a decentralized financial system is only more attractive to users when the rule of law is weak, then the first step is to strengthen the rule of law in the existing system. And so this is the March 2009 cover of Condé Nast Portfolio, and it says, "Trust, we had it, he stole it," meaning Bernie Sanders. But it wasn't just stolen by Bernie. And so regaining trust is going to prove to be very difficult. And regulators are going to use these new digital instruments, including central bank digital currencies, to promote trust in the system. So how are they going to do that? Well, physical paper cash is very difficult to trace and monitor. Transactions are, of course, anonymous. But digitization ensures far greater transparency than is possible with physical cash. You can trace and monitor cash flows much more easily once it's digital. And what that means is regulators are going to crack down harder on financial crime in the coming years. The goal of which will be to demonstrate to the public that the traditional financial system can be trusted again. It'll be part of a multi-pronged strategy to push back against these private money issuers, including cryptocurrencies, to make sure that they maintain monetary sovereignty, that they have maintained the monopoly over the issuance of money. And this means that there are some growing legal and regulatory liability risks for incumbent financial institutions in the coming years. The second key thing to look out for is rising financial stability risks. And so during the famous Dutch tulip mania, peak prices for some unusual flower bulbs reached more than 5,000 guilders, roughly the same price as an elegant canal house in Amsterdam at the time. And so, of course, these were wildly mispriced relative to one another. But today we actually have a similar situation in crypto markets. On the left up there on the screen is an Ether Rock. It's a non-fungible token, a new variety of crypto instrument, basically a blockchain authenticated JPEG drawing of a rock. And it sold a few weeks ago for more than $1 million. On the right, you have a 6-bedroom luxury villa in George Clooney's neighborhood on the shores of Lake Como, also currently on the market for around $1 million. Crypto assets are now collectively worth more than $2 trillion. That's no small chunk of change. And historically, financial stability risks, even in seemingly obscure markets, have a way of spilling over into the traditional financial sector. And so these developments, these new markets demand close monitoring. The third implication is companies need to start thinking about negative interest rates. And so already about $8 trillion worth of government debt trades at a negative interest rate, mostly in Europe and Japan. And keep in mind that a negative rate means a government earns money by borrowing. It's this topsy-turvy world where you earn money by issuing debt. And so a negative interest rate is in practice a tax on holding low-risk instruments, including cash and sovereign debt. So what happens is government revenue goes up and the private sector surplus goes down. You effectively get charged for demanding safe assets. Now, in the current world, negative rates are bounded only slightly below zero when physical cash is in circulation. And when you have paper cash available. And that's because firms and households can arbitrage the rate. If the ECB or the Bank of Japan tried to cut rates any further below minus 50 basis points or 1%, everyone would go to the bank and withdraw cash and stick it under their mattress to avoid the charge. But with no physical paper cash in circulation, by going fully digital, it means that negative rates are unbounded. They can go as low as necessary, minus 10% or more. And so this is both a risk and an opportunity for businesses. Corporations are currently holding about $4 trillion in cash on their balance sheet. Now, all that cash sitting there, in the current world, it doesn't earn much interest, but it earns a little bit of interest. In a negative interest rate scenario, you have that cash creates a liability, an interest rate charge. And so think about what it means for your business if holding cash becomes a liability rather than just as an asset. So that's the risk. You're forced further out the risk curve. You have to pay to hold safe instruments on your balance sheet. Now, at the same time, there's an opportunity here, which is having a very strong balance sheet and operating model. And so there's a former bond trader turned historian named Sidney Homer, who wrote a book called A History of Interest Rates, looking back 5,000 years, bond markets, debt markets for 5,000 years. And what he showed is that during periods of institutional crisis, large companies can actually become pillars of social stability. Some highly creditworthy corporate borrowers are actually able to issue debt at interest rates lower than the sovereign, than the government. And this is quite unusual, as we normally think of government debt as risk-free and corporate debt as having an added credit risk premium. But it's not always the case through history. And so in theory, well-managed and cash-generative businesses could earn income by borrowing, by issuing debt in a world of negative interest rates, by offering people a safe asset that they can hold. And so managers should be thinking about how to position their balance sheets to take advantage of such an opportunity should it arise. And the last one here I want to talk about is growing cyber ransom risk. And so these global digital transactions, anonymized transactions, enable ransomware and other cyber attacks. And so companies are increasingly being targeted with hacks that take control of critical business systems before the attackers demand payment in cryptocurrencies. And so up here on the screen, this is a want ad from the Black Matter ransomware gang. There's an open market for this type of activity, and what they're looking for is employee network credentials, and so they can begin to infiltrate companies that have more than 100 million in revenue, according to the advertisement. And so, until regulators crack down on these type of on these crypto markets, you'll see these attacks continuing. And a recent study showed that ransomware gangs prefer to target companies in the U.S., Europe, Australia, and Canada. So there's a couple other risks that could come from this, but I'm conscious of time, so I'll stop there and open it up to questions. Thank you all for listening.
So, Ben, I got to tell you, they say that you learn something new every day. And I think I learned enough to carry me through the end of the year. And I think I speak for a lot of others too, because I'm sure you could have actually unbundled this presentation and gone pretty deep on any number of the topics you presented. So thank you. So I'll be watching for questions here. But I have a couple while we're waiting for questions, and I would remind all of our participants to good time to go to the comment section and drop a question in there for Ben. But I have a couple for you. So, you know, one of the things I appreciated was the fact that you linked this back to history, because the evolution of money tells us a lot. Not only are we, you know, able to apply old ideas with technology tools we have available to us today, but just the thought process behind these things. In fact, when I look at a $20 bill, I'm reminded that this is a Federal Reserve note, and it says that this note is legal tender for all debts, public and private. So the point is we're used to this in our generations because we accept it as money. And
Correct.
so I think there's a natural tendency to kind of resist. Why do we have to do all these new things, cryptocurrencies and all these other things that you went through? So, but it is the natural evolution of things. I mean, we're just used to the things we're used to, but there's been a whole lot of things before this point in time, right?
Yeah, correct.
So the big question I have for you is what do you see as becoming quickly obsolete as a result of some of these things that are unfolding now?
Yeah, sure. Well, so the one area that stands out, it's already being disrupted, but I think that there's a significant more potential is the payment sector. And so in the U.S., payments cost 2.5% of GDP every year. That's an extraordinary figure. In Europe, it's less than 1%. It's around 80 basis points. And so now in a world of CBDCs, where the central bank creates a ledger and then opens it up for people to develop applications on top of that. Pretty much anyone that can formulate an API call can offer a payment mechanism, right? It's just crediting and debiting two accounts on the ledger. And so I think these will stimulate tremendous competition in the payment space, and those rents, the 2.5% is going to start to shrink as a share. And so I think you'll start to see a lot of old tech that's underpinning our current payment system becoming obsolete pretty quickly once you have this new infrastructure in place.
You know, I've always thought to figure out where the money is flowing, just watch the Super Bowl and see who's advertising. And when all the credit card companies are advertising on the Super Bowl, what does that tell you? That, you know, every time we just swipe a simple credit card, there's 9 people getting paid, right? So
yeah.
Here's a great question. I think we just saw that Salvador has adopted Bitcoin, I think maybe, or another cryptocurrency as its primary, you know, currency. What is that telling us, and where is that something we should care about, seeing that happen?
It's an interesting experiment. I wouldn't characterize myself as optimistic. So a bit of background is worth highlighting. El Salvador is already a dollarized economy, so it has a local currency. It's not widely used. Mostly people rely on the dollar because of a history of high inflation with the other instrument. And so really what they're adopting is a third currency, a third medium of exchange for an economy. That's an extremely complex situation for consumers and businesses to manage. It's very unusual. I can't think of any episodes in history where a country has three different currencies in circulation, and so that complexity has a cost. It makes coordination more difficult. It makes advanced forms of economic activity more difficult. The other thing to point out is that and the IMF and the World Bank have written on this. So if you're interested in reading more, you should refer to them. But Bitcoin is not a very good instrument for a poor country, a country with relatively low incomes, and that's because it's so volatile and risky. Now, about 80%. A recent survey by the El Salvadoran Chamber of Commerce showed that 80% of the people in El Salvador don't actually want it. So there's not really organic demand for this type of instrument there. It's a top down order, and so I don't think that there's people really want to be holding or storing Bitcoin in El Salvador in any real significant volumes. And so I don't think it's going to be a particularly harmful experiment. I don't think that it'll get used very much. I think it'll mostly be a novelty, and we'll see where we are in 12 to 18 months.
You alluded to it, but we have a good couple of questions related to how these new currency, like the Chinese program, says these will be easier and cheaper to print, and then inflation can happen because of them, right? I guess it's the opposite is true if there's a crash in one of those new currencies, correct?
Yeah, well, so I mean, this presupposes a very strict quantitative quantity value of money theory, which is that every time the money supply goes up, then you have inflation downstream, right? More dollars chasing the same amount of goods. But actually, that's not true. I don't think most central bankers believe that. I don't think most economists believe that anymore. Money is supply and demand, and so if demand for money goes up, like it did in March 2020, for example, if you increase the supply of money to meet that demand, then the value of money doesn't have to change. You don't have to have any inflation as a result. Now, with that said, these instruments I do think will provide central banks with more ammunition. Some of the instruments, like we talked about, the negative rate instruments that are personalized, they can be targeted to specific households or specific states or specific industries, right? You can begin to really drill down once you have digitalization. Think about the way advertisements are targeted to us, and imagine a world where tax rebates are targeted to individuals based on their personal circumstances, right? Unemployment rebates get targeted to individuals. All right, and so you reduce the frictions between providing offset to the economy during crisis periods, and you can act much more quickly, much more powerfully than you could in the past. And so certainly, that will help central banks keep a floor on inflation. I think that means that we're not going to have deflation, but will it generate, upside inflation? I'm a little bit skeptical. I think that's a risk that a lot of economists are talking about, but I don't think it's a concern near term. I think it's something for the decade ahead, and it's really only in a scenario where we're talking about where additional macroeconomic risks materialize, right? And so you have a need for further stimulus, further policy easing, and central banks are basically at the zero bound and have exhausted quantitative easing. So we're not there yet, but in the future, these things are becoming possible.
Here's a very specific question from someone who I suspect is a Bitcoin investor. It says, do you see a new Bitcoin issuance after the 21 million coins are issued? And what could be the market consequences of that?
I don't. I think the network, the existing network and community around Bitcoin are hard money people. They want to fix supply. That's why they're holding it. That's what they like about it. I think we had this debate with the hard fork, and it's been settled. We have that the community that wanted an instrument that was closer to a currency is now using Bitcoin Cash. And so there's no longer this tension within the Bitcoin network. You basically hived off the people who would have wanted this into a new community, and the existing community that are hard money folks are keeping those, want to retain that strict supply. So I don't see that there's a likelihood of any additional issuance of Bitcoin tokens. But it's worth keeping in mind that Bitcoin itself, the network resources embedded in the Bitcoin network are scarce, but there are more than 4,000 crypto tokens out there, right? It's just a piece of software. I can go and download the Bitcoin software myself right now and launch it on a server and have an equivalent function, right? The difference is that no one's going to use my token because I'm the nobody. I don't have the community. I don't have all the setup. But actually, the underlying software, the code, is identical and can be reproduced time and time again. And so this is why you have even some meme tokens like Dogecoin, which started out as literally a joke, copying the Bitcoin software and launching it with a meme wrapper on top. These things are still in operation and still being used. But so the supply of Bitcoin itself, the actual cryptographic signatures that come with that network, are scarce, but digital tokens are a dime a dozen.
Although you have to admit, Bencoin has a nice ring to it, right? So, there's a natural tendency, I think, for U.S. businesses who may not do much internationally to kind of shrug off a lot of these things as like, well, this, I'll deal with the changes in payment processes and these things. So what do you say to, specifically to those companies that don't currently do a lot of international business, that, oh, I don't have to worry about any of this. I can just kind of keep doing what I'm doing and never think about it?
Well, so I think international payments are going to be disrupted. Central banks are taking interoperability into account. Central banks are probably the most coordinated globally among national institutions. There's a range of fora that they engage with. They work together very closely in terms of things like swap lines and liquidity lines. They share research staff regularly. They have regular communications with other international central banks. So I do think that there's going to be changes coming on that front associated with CBDCs. But CBDCs are also a domestic change, right? It's a revamp of the domestic payments infrastructure, the domestic payments and financial rails, and there are some pretty serious risks that could come with that. I think they're likely to be well managed by central banks. They're comfortable and they know what they're doing, and I think they move very slow. They're methodical institutions. So, but there are some risks, and so if you think about the two CBDC models, retail and wholesale. A wholesale model which is targeting payments functionality. So that's the one that's coming in the next, say, 2 to 5 years, where you have the central bank managing a centralized ledger, and payments operators will conduct transactions on that ledger. The risks there are really disruptions to existing payment systems, and that's all purely domestic. And so there could be some payments providers that go under. There are credit risks involved with accepting payments from those providers. Those things could materialize in a situation where margins are eroded very, very rapidly. So that's the first point. The second point is that in the retail varieties, which are targeting a store of value function, where the central bank offers a direct deposit to the consumer. So instead of putting my cash at a commercial bank, I stick it on deposit at the central bank. Well, that may attract significant flows away from commercial banks and towards the central bank because it's less risky, right? Commercial banks have very mild, very low liquidity and counterparty risks, right? You take some bank credit risk when you deposit it at a commercial bank, not much because there's deposit insurance and these type of things, but there is some, and there's some liquidity risk. Whereas at a central bank, this is truly a risk-free instrument, right? It's sitting at the central bank. They can, it's a digital deposit, and so you get all the benefits that come with that. Now, in that scenario where you have significant flows away, that could destabilize the funding base of commercial banks. And unfortunately, when commercial banks get sick in a capitalist economy, we all catch a cold, right? And so the commercial banks will try to shore up their balance sheet position. They may have to replace their lost funding base via deposits with wholesale funding, which are riskier and more volatile. That may tighten up their loan portfolios. They may be less willing to extend credit risks. They may reduce their loan books, and particularly some of the risky loans that they have, in order to better match the volatility profile between their liabilities and their assets. And so overall, these type of risks could materialize. You could get an effective tightening of financial conditions as a result of this shift away from the old infrastructure to the new infrastructure.
Well, and as you pointed out in your presentation, a big point to recognize is that currency is really just data. It's information. We've gotten away from this thing here. And so I think that's going to continue to drive everything that you talked about today. So, well, listen, I think we've reached the end of our time. But Ben, like I said, I think I speak for a lot of people, definitely for myself, that you've given me enough daily education to get me through the end of the year. And there's several points of curiosity that now I'm wanting to go research myself. So thank you so much. Do you have any other things that you want to throw on the table before we bid you adieu?
No, that's great. Delighted to be here. I hope you all found it useful. And if anyone wants to reach out and discuss these things further, my email is up there on the screen. It's ben.falk@uk.ey.com. So hope to hear from some of you, and have a great week.
Yeah, and as a reminder, this has been recorded, so you can listen to it again, or bits and pieces of it, and share it with anybody on your team that you need to. So thank you so much for joining us this morning.